Investment trusts have a unique advantage when it comes to paying a regular income. So in this video, we'll look at how they compare to dividend ETFs, pick out some of the best funds, and also explore whether they're worthy of being included in your portfolio. Unlike other types of funds, investment trusts don't have to pay out all of their income from their portfolios each year. They can save up to 15% and keep this in a revenue reserve. This allows them to hold back income in good years and then pay out that income in not so good years, allowing for smoother payments. This has allowed many investment trusts to pay consistently rising dividends for decades, through good times and bad, a record unrivaled by other types of funds, such as ETFs and mutual funds. You've probably seen a few of these dividend-focused style videos, but perhaps not covering investment trusts, which tend to get less coverage than popular ETFs. So before we look at some of the best funds, let's quickly cover some of the main differences between investment trusts and the ETFs that you may be more familiar with. Investment trusts are closed-ended as opposed to the open-ended nature of ETFs and mutual funds. This means investment trusts have a fixed number of shares in a similar way to an individual company. And it means depending on what happens with supply and demand, the share price can move away from the net asset value of the fund. And this creates what's known as either a premium or discount. Investment trusts are allowed to use gearing, which is essentially a form of borrowing to invest. This allows them to take advantage of opportunities when they arise to a greater extent. So it's essentially amplifying returns. So it does mean in good years returns can be stronger, but there is also potential that bad years returns can be worse. Although I should say that most investment trusts use gearing to a very low percentage. Most investment trusts are actively managed. ETFs can be both actively and passively managed, but the majority that most people will be familiar with will be passive, which means they simply just track an index. When it comes to actively managed funds, you're not just placing a bet on the underlying holdings, you're also placing a bet on the fund manager and their ability to beat the index. Generally, this means you will pay a little bit extra for active management, but as we'll come on to, with dividend-focused funds, the difference tends to be quite small. The income from investment trusts tends to be smoother. As we mentioned before, the fund manager can hold back up to 15% of income in good years to then be deployed in years that underperform. This allows them to have a smoother dividend profile, but also increases the ability to increase those dividends consistently. With an ETF, it has to pay out whatever income is produced in that period. One of the key traits with a dividend-paying company is consistency. You don't want a company that just pays a one-off dividend or one that sacrifices financial health in order to sustain it. And while the ability to pay these dividends long-term is important, it's also crucial they have the ability to consistently increase it. Due to inflation, you don't want a dividend that just stays the same the whole time. This is research done by the Association of Investment Companies, and it looks at investment trusts that have consistently increased their dividends for 20 or more years, known as dividend heroes. It also highlights what it calls the next generation of dividend heroes, ones that have increased dividends for at least 10 years, but less than 20. This is a great starting point, but we can't just look at consistency. We've also got to consider things like total return, yield, price, cost, gearing, and what sector or region it covers. Take this global smaller companies trust, for example. It's had 55 years of consecutive dividend increases. And on the face of it, it doesn't seem too bad. There's just a few things that would make me avoid this one. Dividend yield, for example, 1.57%. It's okay, but if you want this income paid out, you really want this above 2%. Gearing's fine at 3%. It's got a discount of -4%. It's not extremely high, but there is a discount there, which you could see as a good thing. But also you've got to think there's a reason why it's been priced as a discount. It only pays out twice a year. So again, if you're having that income paid out, really you're going to want it quarterly. And the ongoing charge, 74 basis points, is quite expensive. And the other thing I would look at is its performance. Over 5 years, it's been pretty good, but over 10 years, it's underperformed its comparative sector. And also look at this value and index property income trust, which has had 38 years of consecutive increases. Unlike that other fund, it's got a really good dividend yield at 6.81%. It pays out quarterly, and performance-wise, it has beaten its sector over 10 years. But the things that would make me avoid this is, one, the gearing at 55% is extremely high. It's going to be a very volatile fund. And the ongoing charge, 1.88. It's just so expensive. So I've picked out 4 dividend-focused investment trusts that I believe are some of the best on the market right now. 2 covering the UK market and 2 covering global markets. And this is a criteria I've used to help me narrow down the options. The dividend yield needs to be more than 2%. The gearing level needs to be less than 10%. Any discount or premium needs to be less than 8%. The total return over 10 years needs to have beaten its benchmark or its relevant sector. And it needs to pay out its dividends quarterly. First on the list, we've got the City of London Investment Trust. Trust, probably one of the best known ones here. And this has a massive 59 years of consecutive dividend increases. It covers the UK equity income sector and it's managed by Janice Henderson. And the things I like about this fund, first, the gearing is pretty low at 5%. Anything under 20% I think is absolutely fine. Once you get over that, I think it does start to become a little bit more volatile. It has a premium of 1.94%. So you could say that's a negative because you're paying more than the actual value of the fund. But also I think that's because investors are valuing this fund as a good proposition moving forward. It's got a dividend yield of 3.78%. It's not the highest, but I think that's still absolutely fine. And it pays out 4 times per year. One of the best things about this fund is its ongoing charge at 36 basis points, which is so competitive. When you're thinking about a typical ETF, you're probably looking at that and thinking that is quite expensive. But when we compare this to dividend-focused ETFs, so I've just picked out some of the most popular ones here, you can see a range from 29 basis points all the way up to 45 basis points. So for an actively managed fund, I think this is great value. And a lot of that value is derived from its ability to beat its benchmark or sector. And in every time frame, 1, 3, 5, and 10 years, it's beaten its sector. So the key trait with this fund is stability and reliability. There's going to be funds out there with a higher dividend yield and a higher performance track record potentially, but that's not what you're paying for here. Here you're paying for that dependability of that income. Next up, we've got the Merchants Trust, also covering the same sector, the UK equity income. And this has had a 43-year consecutive run of dividend increases. With this fund, you will get a slightly higher dividend yield at 4.52%. It still pays out quarterly, and its gearing percentage is relatively low at 8%. It is currently sitting at a discount of 4.25%. I don't think that's too bad. If this were to creep up closer to, say, -8%, then that probably would make me want to avoid this because I feel like most investors are pricing that in. That could be a reflection of its performance in more recent years. Looking at 1 and 3 years, it's performed 25 and then 25.8 in a 3-year period, so very close together for both of those time frames. If we compare that to the City of London Investment Trust, it's sitting at 33.8 and 51.6, so quite a big difference there. However, over a 10-year period, the City of London Investment Trust has done 156%, where the Merchants Trust is on 182%, as well as outperforming the sector too. So I don't think there's necessarily a long-term concern here. I just think in more recent times, people have moved away to other investments. It is slightly more expensive though, so 52 basis points. Again, that could be another reason why people might be looking elsewhere. But overall, I think this is still a really good fund. And now on to the 2 global investment trusts, the first one being the Murray International Trust. And this has had 20 years of consecutive dividend increases. So the first key difference is the obvious one. Here you get global diversification. So you're not just putting all of your eggs in one basket covering the UK market. Here you're getting global exposure. It's got a dividend yield of 3.3%, which is not the highest, but it's still pretty good. And what I love that in the objective, it says to achieve an above average dividend yield. So that goes into the decision making for picking those companies. Like the other funds, it pays out quarterly. It's got a very low gearing ratio at 3%. And it's sitting at a slight premium at 1.33%. Similar to the other funds, it pays out quarterly and it's got a low gearing ratio at 3%. And this is also currently sitting at a premium of 1.33%. Ongoing charge-wise, it's sitting at 52 basis points. And I would say that's probably middle of the road for these types of investment trusts. One extra thing we do need to consider here is this being a global investment trust, we need to consider its regional diversification. It currently has 51 equity holdings, as well as a small percentage in fixed income. 51 is not the highest amount, but it is still reasonably diversified from a regional perspective. 30.9% in North America, 25.1% in Europe, excluding UK, for example. I think if North America was closer to what it is in the global stock market, so closer to around 60%, that would be more of a cause for concern. But around 30%, I think this is absolutely fine. And performance for this fund has really been where it's shone over every time frame, 1, 3, 5, and 10 years. Over 10 years, a massive 253%. So from an all-round perspective, I do think this is a really solid choice, but there is still another option we need to consider. This is slightly further down the list, and it's the Invesco Global Equity Income Trust, and it's had 15 years of consecutive dividend increases. In a lot of ways, this is very similar to the previous fund. It pays out 4 times a year. It's got a very similar dividend yield, currently sitting at 3.56%. Very low gearing ratio. This is actually sitting at 0% currently, and a small premium, currently sitting at 0.88%. It is slightly more expensive though, the ongoing charge sitting at 0.78% compared to 0.52% for the previous fund. What I love about this investment trust is in its objectives. With the last fund, it talked about having an objective of above average dividend yield. With this one, it goes a step further and is more specific targeting at least 4% dividend. I should say that's 4% of its net asset value, not 4% of its share price, which would be its dividend yield, because you're probably looking at the dividend yield being 3.56% and wondering why it's not hit its objective. And it still might be slightly under. Of course, it's a target, but it's based on the NAV. So when it's sitting at a premium, like it is now, the share price is going to be above the net asset value. But still, by having that target, you can be confident you're going to get a decent yield moving forward. And from a regional perspective, it has a slightly higher weighting towards both North America and the United Kingdom. And while North America is starting to get a little bit high, I don't think this is cause for concern just yet. And performance-wise, this is the best performing investment trust that we've looked at today over both 5 years and 10 years. 5 years, it's done 110.9%. 10 years, it's done 264.8%. That is total return, but for a fund that's focusing on paying out a relatively high dividend, that's an insane return. So even though it's slightly more expensive sitting at 78 basis points, you've got to weigh up the quality of the fund manager here as well. And one of the key things that separates an investment trust to a typical ETF is in its active management. With an ETF that focuses on dividends, you can set certain criteria. For example, it could be that it has to consistently have increased its dividend for a set number of years, or that the yield has to be over a certain percentage. And of course, it can still cover a specific region or sector. But with an investment trust that's actively managed, not only do you get the smoothing of income, but it also allows the fund manager to look into a company in a lot more detail. It's not just looking at the yield and seeing it sitting at 7 or 8% and then putting it into a fund. It's looking beyond that. What's the financial health of the company? How long has it consistently increased that dividend? But also, what's the total return been? They can also look at things like the cash flow for the company and determine how sustainable that dividend is. Look at the payout ratio, and then they can allocate a weight accordingly. One thing you will have to consider though, if you do want to go down this investment trust route, is that you will have to use one of the more traditional brokers, ones like Hargreaves Lansdown, Interactive Investor, or AJ Bell, for example. You won't be able to use Trading 2on2 or Invest Engine because they don't offer both mutual funds or investment trusts. I'll be really interested to hear your thoughts down below in the comments, so let me know. I hope you found that useful, and I'll catch you in the next one.